Hey everyone, welcome back to the channel, your number one source for income-oriented investing. Today we're going to do another reaction video, which I feel is very, very important on QQQY, JEPY, the Defiance ETFs, but also the YieldMax ETFs. If you own any of these, this is a critical interview for you to see. So Jay Pestricelli did an interview, and in case you didn't know, he manages the options. He's the options manager or the sub-advisor for the Defiance ETFs and all the YieldMax ETFs. So this is the guy who runs the option strategy. So obviously this is the guy you want to hear from, not me or other finfluencers who are just guessing about stuff. You know, I'm going to keep telling you guys that the most important, the most valid information is from the fund managers. It always surprises me, always bizarre that these great Q&As, they don't get that much views. Of course, Jay's been on the channel, on our channel here, twice, and he's going to come back a third time. So we're going to listen in and really focus on a couple of great parts. We're going to focus on the Defiance ETFs first. I keep getting questions about these. People are very confused by these, and it's a lot simpler than you think. So we'll listen in. And by the way, if you want to see the videos on my channel about these, the best way to do it is really go on my channel's homepage, click on playlist, because I have a playlist that has all the US listed stuff. So yes, I cover a lot of Canadian stuff, but I also cover US stuff. If you just want the US stuff, you're American, you just want those, you click on the playlist US listed funds designed for high yield and passive income, click view full playlist, and you'll see that these are the two key videos for the Defiance ETFs. There's also YieldMax ETFs. I interview the CEO of Defiance. We talk about that. This one is very important as well, QQQY, JPY. A lot of actually what I said in that video is now going to be backed up from what Jay is saying. So it's kind of vindicating what I said in this video, which is awesome. So make sure to check out these videos. Very, very important videos. So let's get to Jay now. And this is where the questions start on QQQY and JEPY. We'll start with that, and then we'll do some YieldMax stuff as well.
To the Defiance ETFs. So you're involved with those too, right?
We are the we're the sub advisor for those funds as well. Yep.
So we had some questions come in about the newest ones, the QQQY and the JEPY, and then the IWMY, which those are indexed for NASDAQ, Russell, and the S&P.
Correct.
So the question is, the funds don't really have any underlying, so not including the daily win and loss of the options premium. So how does the NAV go up in the?
So the question is, because if you look at the Defiance ones, if you look at the actual holdings, you'll see that although this one is a NASDAQ 100 and then the JEPY is a S&P 500, you don't really see the S&P 500 and NASDAQ 100 ETF inside of it. The reality is they're kind of doing the same thing. They're holding it synthetically, just like in YieldMax, the Tesla YieldMax ones, or whichever one there is, Nvidia, Amazon, they don't actually hold Tesla or Amazon stock. What they do is they replicate or get access to the stock price movement of the stock. So it's pretty much the same exact thing. I've been seeing some comments, oh, these ETFs don't really hold anything, like it's a bad or negative thing. Guys, I'm telling you, it's the same thing. It's, and this, we talk about it, Jay talks about it on the channel. But now, these ones are a little bit different because they do daily options, and they're in the money put options, which by the way is the same thing as a covered call, out of the money covered call, which is Jay's going to talk about. So let's listen in how he responds to that.
Okay. So believe it or not, they are the exact same thing as YieldMax, just with.
Yes, so I'm vindicated. That's what I've been trying to tell you guys. It's the same exact thing as the YieldMax. Let's listen in why.
A slightly different structure, right? YieldMax does what? Long call, short put to synthetically create what we call a combo that gives you your up and down exposure with a covered call for.
So that combo, that long call and put combination, that gives you access to, it replicates having the Tesla stock or the Amazon stock. It's literally the same thing. That's why it goes up and down with the underlying, right?
That generates income from selling premium and has an upside capture that's limited, right? Exact same thing with an in the money put. When you sell an in the money put, you have the exact same exposure, just like YieldMax. But unfortunately, a lot of folks don't understand how an in the money put is the exact same thing as a covered call. So I don't want to go through too much of
Same thing.
options 101 here, because I know we want to be efficient with our time, and I know you got a lot of questions.
Yep.
But we absolutely do have exposure to the indexes in those because we're selling it in the money put. The amount that's in the money is the amount of the upside you'll capture. Just like with a covered call on YieldMax, the amount out of the money of the call is the amount of that you'll capture on the upside. The main difference between the Defiance funds is that we're doing that trade daily and the options settle to cash. Whereas with single stocks like Tesla, Nvidia that we're doing in YieldMax, they require us to do, it's just more efficient to run a covered call version with the synthetic. So it's, believe it or not, exact same strategy, exact same tactic. We're selling short-term premium with some upside capture. So that's why on a lot of days where the market's kind of flat or slightly up.
So you remember that in this video here, this one here, I've actually shown you what QQQY does versus QQQ, what JPY does versus the SPY. So this is what Jay is going to be talking about now, and I'm happy to say once again, I was 100% right in my analysis.
You'll see the Defiance funds outperform their index. Right. I think today we did that. Right. I don't have the numbers in front of me. I could look real quick. When I take a look at, let's take a look at QQQY. Right. It was up 28 basis points. The NDX was up 3. OK, great. So that in your mind should be like, oh, that's all the time decay that they sold.
The premium.
Correct.
So what he's saying is that in a flat day, these funds will outperform because of that premium, right? If you're giving up some upside and there's no upside that day because you're doing a daily, it's only one day. That's why I love these ETFs so much. It's a 1 day bet. So if the market is flat that day, you're automatically going to outperform because there's no upside to be had. So you get the full premium, right? So that's what he's saying here. So very, very critical, guys. It's an in the money put. I see a lot of nonsense and YouTubers trying to look at all kinds of charts and all kinds of weird stuff. In the money put is literally the same thing as an out of the money call. It works the exact same way. You're giving up some upside because it's out of the money. If it was an at the money call, right, you're giving up all the upside. So it's an in the money put is the same thing as an out of the money call. So that's why as summarized in this video, these ETFs behave exactly like a covered call ETF. So QQQY actually behaves very similarly to JEPQ. JEPY behaves very similarly to a JEPI or a SPY. They're essentially the same thing, but like Jay says, the only difference is it's a 1 day bet. It's a daily option. So that resets every day. And that's why I really love these ETFs, because you'll probably get more days where you'll win than when you'll lose. The problem is the days you win, you'll probably only outperform by about 0.25 basis points. Whereas if the market goes up 2% in 1 day, you're going to give up more than 1% of the market. So it's exactly the same thing as a covered call strategy, but it's on the indexes instead, and it's a daily option. So think of QQQY, JPY just exactly like a YieldMax, except it's on the indexes. That's the one difference, right? Obviously the underlying. And 2, it's a daily option. Now you can continue watching. He talks more and more about this, but I want to, let's just listen a little bit more.
25 basis points of that was the time decay. But when you look at SPX, which was up, 16 bips, JEPY was up 33. So again, we outperformed that because it was up on a small amount. The same concept applies for YieldMax, right? It's selling short-term premium. But, so that's where we're capturing the upside. The in the money puts, that's important to know. In the money puts is the same thing as an out of the money covered call.
There you go.
Is going to capture the upside up into the strike. And so I don't want to go through an options 101 lesson about how they're the same, but if you look at the P&L, those two kind of strategies, they're identical.
There you go, guys. So you can watch the whole thing. He talks more and more in detail about it, but that is really the important part. Now let's go at the beginning, because he talks a lot about a very interesting thing about the YieldMax ETFs as well. And I've been getting some questions. Tesla is is up 3-4%, why is Tesla only up 0.5% or not up at all? So that's the kind of questions he's going to answer. So let's go back here near the beginning, and we'll focus on more on YieldMax now.
Right out of the gate, everyone wants to know why Tesla stock has been running up and why Tesla appears to be down in the market.
Yeah, I can't answer why Tesla stock is running up, but I can talk about the fund's participation or lack of participation.
Right. And it's because it's a covered call ETF. But you understand the question, right, guys? If Tesla's up 2 or 3%, why isn't Tesla going up, which is the YieldMax with the same exposure to Tesla? So listen to what Jay says.
In the upside of the movement of Tesla, the simple answer is our calls are deep in the money, right? So like any covered call strategy, when the market goes through your short call strike, you're capped out. You're done making money. Now, for us...
so what does that mean? What does it mean when you're capped out? Well, if Tesla's at 100, you sell a call at 105, and Tesla goes to 106, 7, 8, 9, 10, you're in the money. You've reached the ceiling of that option. That's what he means. So you're not going to capture further upside after 105, right? So that's what he's saying.
We typically let that run until all the time decay is out of the short calls, and I'm sure we'll get more into that in a little bit. But the simple answer is we were through, right? What did Tesla close at today, right? 240-ish, right? And our main position were the 217 halves. So we really stopped making money at the 217.5 level, with the exception of the remaining time decay that was left in the options. That's the answer, right? I mean, this is the scenario with any covered call strategy, right? You get paid the premium to give up some potential upside. And
that is the whole, if I could summarize a covered call strategy in one sentence, that's what it is. You are getting paid a bonus or a premium or money to give up some upside. That is the sacrifice of a covered call strategy. And this is why they work well when there is no upside, because there's nothing to give up, guys, right?
In this scenario, though, it's not the first time this has happened to us. When I say us, I mean the fund, where the stock has moved strongly through the short call. Happens fairly frequently with volatile stocks like Tesla or Nvidia. So that is I think that's the simplest answer, right? Stock went through our short calls, and then I could have a caveat to that, but I want to hear if you want to follow up on that one, if that's not clear.
It's clear, man.
No, that makes sense. Next question related to that is, do you see a path to recovery for TSLY and some of the others that have been beat up pretty good? Because there's a lot of kind of cynicism in the audience about whether or not these will recover. So I want to know
that dreaded NAV decline risk, right? Or NAV decline worry is this question, right? Is Tesla going to go back up to what it was? And let's hear what Jay says.
Your take on that.
Yeah, I guess recover is all, a matter of perspective, right? If it's, I don't know everybody's entry point on the ETF, and I don't know everybody's dividends that they've earned, right? All those things go into total return. But it's completely reliant on the movement of Tesla, right? I mean, as any covered call strategy goes, as the market goes up, you capture some of the upside, at least for ours, because we sell out of the money calls. You capture some of the upside of the underlying movement. But remember, the goal of the fund, the primary goal of all of the YieldMax funds is to seek income, first and foremost. Secondary goal is to capture a portion of the upside movement. What a lot of folks may not realize is, and this is unofficial, but Tesla for the year is up like 34-35% on a total return basis. So, I don't know, that seems fine, right? I guess it all means, what does recover really mean, right? And I've seen some folks who say, hey, can we get back to 20 ever again? And my answer is sure, but it all depends on Tesla and the way that it gets there.
Of course.
Right? So if we're selling calls on a monthly basis or 5 to 15% out of the money, which translates to 2, 3, 4% a month kind of a thing, a week. So, if Tesla has a slow march and we could capture the upside while then harvesting some yield along the way, sure, anything is possible.
So what he just described there is the best case scenario for a covered call ETF. If Tesla, for example, goes up slowly, has a slow and steady march, is great because it's very, very slow. So you're capturing that little upside every week and you're still making that premium. What happens is with these volatile stocks, because it's such high, it's only high yield because the volatility is very high, right? Tesla could go down 3% and then in one day it's up 4% and then it's down 10% and then it's up 0.04. So it's very, very volatile. So what happens with these covered call ETFs is that yes, you could get a lot of yield, a lot of premium, but in those days or that week where Tesla shoots to the moon, that's where it's not that great for a covered call strategy because you're giving up a lot of that upside. But if it was a really slow and steady recovery or going up, it would be much better. But that doesn't exist on a Tesla stock, and maybe it could exist on an Apple stock, but the yield and volatility is much less on an Apple stock because there's more of a chance that it goes that way, right? So you understand what I'm trying to say here. So the number one risk of these strategies is always going to be the underlying stock or index ETF. It really depends what that does.
I think it likely that Tesla has a very slow and methodical march of going up 75% from here. I don't know. I mean, that's Tesla. Who the heck knows what it's going to do? But that's what it would require to get, a price recovery. But from a total return perspective, the strategy is doing what it's designed to do, right? We kick out yields based off of, what we sell on a monthly basis in covered calls. And if you include that in all of the returns of the portfolio, then the ETF is up for the year by over 30%.
Right.
Perfect.
So next question related to that, would you consider, if the fund dropped below $10, would you consider cutting the dividend payout to help the principal stay where it is? Or what would the options be if it kept dropping?
Very interesting question. So basically, the YieldMax, the Defiance ETFs, like I spoke with Jay and he confirmed on the channel, they give out all the yield that they earn. They give it all out, unlike something like QYLD where they only give you half of it, right? So what he's asking is, would you consider, reinvesting some of it into the NAV? Let's see what Jay says.
Yeah. So, okay. So two things here. And we've talked a little bit about this in the past. So the first thing is our goal is to generate income, right? We're going to continue to generate income by selling covered calls, right? So what you're asking us is, hey, would you take the yield from a 50, let's just use that as a broad average, would you take the yield from a 50 down to a 30 in order to, either reinvest more of the dividends into the portfolio, or when I say reinvest the dividends, reinvest the premium into the portfolio, or to give yourself more room on the upside, right? And for us, the strategy has always been the goal of the fund. The name is YieldMax, right? We want to deliver maximum yield. That's the primary goal of this ETF. And I say that with enthusiasm because I think total return of a yield-based product can get confused with growth, right? Total growth.
Oh, yeah.
And growth is not the primary goal of this fund. The primary goal of the fund is yield. So that's maybe the first answer is probably not, right? $10 is $10 is an irrelevant. No, I know you picked a random number, but $10 is kind of irrelevant. At $10, we should be kicking out, whatever that number is, 41 cents in a month, which annualizes to 50%, right? So did that quick math in my head, by the way. I'm sure it's close. So that's the first thing. The second thing is, look, you said to maintain the value, right? This is one of those really key things that I've always harped on when we've talked in the past is it's the value in the portfolio that matters, right? If you start out with $10,000 in Tesla, the value of $10,000 is really what matters because when we continue to pay our yield, you're earning that 50% rate on the $10,000 balance. So what does that mean? It means reinvesting the dividends because what's important is not the value of the ETF. what's important is the value in your portfolio, right? So this sounds really simple, but the value in your portfolio is shares times NAV, meaning ETF price, equals the dollars that it's worth in your portfolio. That's what's important. That's what you're earning your yield on, right? You don't earn the yield on just the price of the ETF. You earn it times the number of shares that you have. So this is why I've always talked about how important it is to reinvest the dividends into the ETF. So we're almost at a year now on with Tesla being live, right? And so if you've been reinvesting those dividends, if you started with 100 shares and we end the year at a 50%, you would have 150 shares, right? So now when you get paid that 4% a month, right, that is going to be based off of a higher share count, but it's all based on that value of what you're shooting for. So, to me, it's about the position in the portfolio. I know a lot of folks talk to me about, well, I just don't want to take all the dividends out and I want to use them. I want to pay a mortgage or I want to live off them. Just realize you're reducing your exposure when you do that, right? There are other funds that will hold on to some of the dividends and not give you the discretion to do that on your own. They'll hold on. I'll think of a real popular one, QYLD, for example, right? Global X, huge fund, 8-9 billion. They will at max distribute 1%. But what do they do when they earn 2% in call premium? They hold on to it and not distribute it and reinvest it for you. At YieldMax, we like to distribute everything that we earn from the call selling. That's what's driving a lot of the yield. But you have to think about what you're doing with those dividends. For us, the general answer is reinvest it, right? Manage the portfolio position, which is so important, not the value of the ETF. It's the value in your portfolio on which you earn the yield.
Absolutely genius answers, guys. This is the key to understanding the YieldMax, the Defiance ETFs. I'm telling you guys, you need to understand exactly what he just said in the last couple of minutes. What he's trying to say is, if you're worried about that NAV going down, it's irrelevant. You're not thinking or counting the income, and instead of a QYLD where they reinvest some of it, he says he wants to give us everything so we could use full discretion, and that's what I want. I want maximum flexibility as an investor. What you do with that humongous dividend is up to you. If you're worried about the decline of the share price, which is irrelevant because it's all based on percentages, you should be reinvesting all of it, some of it, a portion of it. That's the beauty of it. You have the flexibility, right? You have the flexibility, whereas a QYLD, you don't have they only give you 1% or half of the premium. I'd rather get everything and what I decide to do with it yourself. So guys, watch the whole interview if you want. I think later on he compares to, he talks about what if I take out all that income and pay for a mortgage. You could do that, but just remember, of course, the value in your portfolio is going to go down. It's just same thing as buying an Apple stock or an Amazon stock and then every month selling a little bit, selling a little bit, selling a little bit. It's the same type of thing because the return, most if not all the return from these funds, guys, comes from the income. What you do with that income is completely up to you. This is why myself, I went QQQY, JPY, all in the retirement accounts on drip, right? And I'll show you the value of my investment is going to go up with that redistribution, is going to go up and up and up, even though the fund price could be going down and down and down. It's like he said, the share price of the ETF is irrelevant. It's all based on the value of the investment. So guys, I hope this video was informative for you. I strongly suggest check out this Q&A, the whole thing. It's 50 minutes. This guy Jay is on all kinds of, he always says the same things, but I found this one, the way he answered them was really, really good. So hopefully this video was informative for you and you now understand exactly YieldMax, Defiance ETFs. They all work the same way. So these are awesome funds, and you shouldn't be worried about a declining share price because it's just designed that way. It's completely normal. You got to take that income, reinvest it if you're worried about that, or go with another fund that's giving out like maybe 12% yield and where the share price is, stays flat or goes up. Just know that it's pretty much the same thing. One has more yield and a lower share price, the other one has less yield and a more stable share price. In the end, all that matters is total return and value. If you don't believe me, and the value of your account, if you don't believe me, these ETFs have not been around for a very long time, but do QQQY versus JEPQ, do JPY versus JEPI versus SPY, and you'll see that their performance is very, very, very similar. So hope this was informative for you. Let me know if you have any other questions. I'll have Jay back on my channel as well when the all-in-one YieldMax comes out. So see you next time.